Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by Zach's Director of Research, our earnings expert, and also our expert on the oil industry, Sheraz Mian, who's been on the podcast several times, and this is part 2 of this times podcast, I guess you could call it.
That's right.
Because we're going to give our picks on the energy sector for this, basically, I guess, the second half or
And beyond.
going forward.
That's
yeah. So let's just jump right into it, I guess,
Sure.
because we've already covered kind of what's going on in the oil, and everybody can go listen to that other podcast and see
Sure.
what we think about that. But now comes down to, the nitty gritty. Where should we be? I guess we should start with the big integrateds, because those were real popular with both you and I earlier.
That's
when
right.
we were talking about this. Do I still need to hide out in Exxon and Chevron, or is that done now?
No, I don't think it's done. But it is done if you have the stomach for absorbing the day-to-day volatility that an E&P or oil field service or a driller would inevitably give you. So if you have a longer holding horizon, that holds true for the other folks as well. But if you want steady growing income, you want less risk absorption, then I think you still have to look at the integrators. They are blue chips. Exxon is no longer AAA.
I know.
It has followed the U.S. Treasury now, and it's just AA. But those are extremely profitable. Even though Q2 was kind of duds for both of them. And very good balance sheets, global operations, very well run. They have the ability to absorb and profitably operate even in a low price environment for a very long time. Net, I like Chevron better between the two.
I was just going to ask you that because you liked them better the last time too.
That's right. Chevron is the oilier of the two. It's not as super efficient as Exxon is, but that's just in relative terms. Exxon is effectively the best operator in the oil patch, so anybody relative to them is less efficient. But they have a very deep pipeline of projects coming up over the next any time horizon you look at. And a very juicy, safe dividend, strong balance sheet. So I think in a diversified portfolio context, folks should have some allocation to the integrators as well.
Okay, so by oily, do you mean they just produce more?
They produce more
and it's
oil.
Heavily weighted towards that in their business.
That's right.
Okay.
So the relative proportion between the oil, natural gas, and the other hydrocarbons, they produce more oil relative to the super majors, the Exxons, the Totals, the Shells, the BPs of the world.
Okay, so Chevron would actually benefit if we do see those real optimistic price targets of even like $60 a barrel more than Exxon.
That's right,
Okay.
and it would suffer on the other end as well.
Right.
If
With the doom and
gloomers,
gloomer guys.
Exactly.
Yeah.
That's right.
All right, that's something to keep in mind. Now, I also did see something about Chevron that I thought was interesting about their dividend, because we've talked about this in the past about who will keep it, who will not. It seems clear now they're all keeping it.
That's right.
And nobody, even BP hasn't cut theirs.
That's right.
I think I saw a couple cuts in the big, like Colombia's oil company down there, Ecopetrol. I think they cut, but we did talk about that, about how it might not be safe in some of those countries. But the U.S. producers and the British producers have all kept their dividend. But I did see that Chevron is paying its dividend now with completely borrowed money, apparently. And now there's a question about whether or not it's going to actually raise it this year, not cut it, but raise it. And
That's
it is one of those dividend aristocrats that I think Exxon is too, who has been doing it, raising for like 30, 40, 50 years. They're one of the like 20 or 30 companies that has managed to do that, raising it once a year all that time. Do you think they're going to do it again?
I think that's a legitimate question that the mid-single-digit growth that Chevron shareholders have become used to, they will probably not get that. They could probably announce some token increase just to keep their record intact.
Right.
But you're right, they're borrowing money to pay dividends.
Yeah.
They still have plenty of capital expenditures on their budget, but they have a fortress balance sheet. They could borrow as much money as they want, even if the market was not supportive. So I wouldn't be concerned about their cash flows.
Okay.
But pretty much everybody in the oil patch is in cash flow deficit right now.
Right. That's for sure.
And it's not unusual for Chevron and Exxon to be in deficit as well.
Okay. Their yield is 4.2, Chevron's, and Exxon, just for those wondering, is paying 3.4. But Chevron's always paid higher.
Chevron has always been a higher yielding. BP is much higher.
Yeah.
It's close to 7%.
I know, real
and
juicy.
that's putting some question as to whether that's some tentativeness or uncertainty in the investor's mind that it may not be as secure as the Exxon and Chevron is.
Every quarter, that's basically the first question, I believe, that they
That's
get.
right.
Like, what's happening with the dividend?
What will they cut? Yeah.
Right. So far, the CEO has said the dividend is safe and it's staying there for now.
We will see. We will see. I won't be counting on BP
Okay.
to the same extent. I would be counting on Chevron and Exxon to hang on to their history of dividend.
Yeah.
So that'll be my take on that super juicy dividend.
Okay. We're going to have
had.
to watch that.
Yeah.
I own that one in Value Investor. So now I'm getting a little nervous about that. But okay, we'll see. Now, switching gears, let's go over to a little bit riskier plays, the EMPs. Those were, the place you did not want to be the last couple of times we've talked about, which stocks to pick. But now, if people are thinking we've hit the bottom, isn't this is an area where you do want to be, but you have to be picky on which of these. We've said that the whole time. But,
Absolutely.
But now it's becoming more clear. I think I saw somewhere that there's been like 150 bankruptcies among oil companies now, but they're not all created equal.
Absolutely. We mentioned in the past, if I remember correctly, that of the things you have to be mindful of is more oil exposure, the extent of production that's hedged, the quality of the company's balance sheet, and all of those attributes still matter. What you want to do is to have an E&P operator, if that is something you want to do, and perhaps folks should do that if they have the risk tolerance. Depending on your risk tolerance, you could have large caps, mid caps, small caps, but within each category, you want a company that could stand on its own if oil goes back to the scenario that the doom and gloomers are painting. And there's plenty of opportunity there. We have, as we have mentioned in the past, Pioneer Natural, PXD, that's in the top 10. Not really a big company.
They had a real good quarter.
They had a very good quarter, absolutely. So the oily, more levered to oil versus natural gas. The typical E&P company historically used to be 2/3 natural gas, 1/3 oil. When oil started going down, they all started focusing more on natural gas, and then it has been coming back. So not everyone has the same proportion of oil in their production stream. So you want to be more exposed to oil. And PXD is one such. They have strong production growth. They guided higher, as you mentioned. Very deep hedge position this year and next, and a very strong balance sheet. And there's variety of others. Many of the others that we mentioned the last time are still valid. Occidental, I mentioned. OXY is another one, a bit bigger in size. Strong balance sheet. Extremely well-run company. Strong cash flows. Pays a dividend too. Has some chemical operations as well. And further on the size. I like Anadarko too. Um uh, they they had acquired 10, 15 years back this company called Kerr-McGee, which had a lot of Gulf of Mexico assets, and uh, among the E&Ps, the large cap E&Ps, I believe Anadarko has perhaps one of the best project pipeline. The balance sheet is reasonably good too. It's a well-run company. They haven't done that much, I believe, in the last couple of years, but they could be a consolidator in the space too.
I've been kind of following Whiting Petroleum for a while because I used to own that in the Value Investor, and then it all collapsed down. Their ticker is WLL. They're a big in Williston, and they used to have, well, they own a lot of acres in the Permian too, but they just recently announced they're selling some of that for about $300 million. So they're getting rid of some assets, but their earnings estimates are moving, finally in the right direction. They're
That's right.
still losing money, not making anything, but they've gotten rid of some non-performing assets, and it seems like things are moving in the right direction. A lot of the analysts were saying about them that if WTI gets over $50, this kind of company becomes even more attractive because obviously that's when
That's right.
everything really starts to pick up.
So there's a number of operators who really benefited from the boom when we had the Bakken area was an extremely good position. Whiting is there. Continental Resources is another one. EUG is another one. Hess has large operations over there too. Uh, um, all of these, Whiting in particular, I believe, I'm not 100% sure, but I believe doesn't have as good a balance sheet as you could find elsewhere in the space. And pretty much all of the E&P players have some exposure to Permian, but you want a player which has Permian as their primary asset base.
Right.
And in that respect, I believe Whiting will have some exposure to Permian, but not to the same extent as you could find with some of the others, with the Anadarkos, with the Pioneers,
Okay.
and with the other players. So, but in a stable oil price environment, a number of these guys have been beaten up so much that perhaps there's better value in there relative to some of the other players.
So if we see crude fall further, because it's around 40 when we're recording this, and if we do test those $35 levels again, and these crude stocks, these energy stocks are going to sell off if we go down
That's
there.
right.
Is that a big buying opportunity? Should
I believe
investors
so.
really be jumping in again here?
I believe so. It's always tough to recommend something with a very short term holding horizon. But if folks are looking for quality E&P players for the long run, then even now I believe would be good spots. But if it pulls back some more, which is possible given the overall weak sentiment on the commodity, and this is a seasonally weak period as we discussed in the other podcast. So I strongly believe that quality E&Ps that you plan to hang on to for 6, 12, 18 months, you probably may not get as good opportunities afterwards.
Okay. Now, what about the services? That area seems to be really challenged still. Should we stay away from those?
I believe so. The reason is that when every E&P company, when every Chevron, Exxon, BP, and Shell is cutting their capital budget, they're basically cutting the revenues for the Halliburtons, the Schlumbergers, the neighbors of the world. And in order for those guys to stay in business and maintain market share, they have to cut their prices and do jobs on prices and revenues that at times is a third or a half of what they earned 2, 3, 4 years ago. And we referred to earlier 900 being the new 2000 for the rig count, and that's the hope these guys have that once we get to a 900 plus rig count level, there'll be enough oil field services, oil field activity levels in North America, at least, which will give them some pricing power and some bargaining power. If folks have the ability to absorb some of the risks and the volatility in this space, there are large players in the services space as well: the Schlumbergers, the Halliburtons, the Baker Hughes. I personally would prefer somebody like Halliburton. It's a very well-run company, has good balance sheet, pays a dividend too, has a lot of operations in North America, and the type of stuff they do will be amongst the first that will come back when the activity levels in the oil patch recover. So they will be in the forefront of the recovery. Some of the others, Schlumberger and Weatherford, for example, they have a lot more international exposure. Those markets will likely remain depressed a bit longer. So they will recover eventually too, but perhaps after Halliburton has recovered.
I owned Weatherford in the insider trader for a while. It was very volatile
That's right.
because the insiders were buying up those shares. But it's just with crude declining like that, everybody's just jumping out of all these energy stocks.
That's right.
So
They
we
have-
didn't have the long time horizon.
That's
in there.
right. They have plenty of operations in Mexico, in Brazil,
Yeah.
Argentina, and those markets will remain depressed for a while.
Okay. Now, what about any other companies that are kind of tangentially related? Maybe some of the transports, or should I be looking at those?
Sure. So it's all a question of the level of diversification you get. For the income folks, I think MLPs are good choices too. There are plenty of variety in the MLP space too. You have pure transporters that have just the pipelines and the storage tanks, and then you have a variety of folks who do some kind of processing and fractionation of the in the value chain as well. I have long been a fan of Enterprise Products (EPD). It's the best of the lot in that space. It's the largest player in that space as well. Far more stable in terms of the price volatility relative to some of these other players. But there's plenty of other opportunities in the MLP space as well.
Okay, this has been great. I hope people really, take some of what you said to heart here. It's good to get like actual picks in this sector, and it's
Sure.
good to get some perspective on, having a longer term time horizon, because you sit there in these stocks and you look at them. I mean, some of them, very volatile
Sure.
every day. And so you kind of have to remove yourself out of that if you're a
Absolutely.
longer term investor.
That's right.
And think about the bigger picture. So thanks for joining us, Sheraz. This has
Sure.
been very helpful. If you want to hear anything more about what Sheraz is thinking about any of these topics, and also on earnings, because he is our earnings expert, you can check out all of his articles on Zacks.com, of course. And you can listen to our other podcasts on SoundCloud and on iTunes. And I think we're on that Amazon Alexa thing, or Echo. What is it, Alexa? I think that's what it's called. Yeah. Danny's giving me the thumbs up. I don't have one of those, but a couple people here at Zacks now have that. So you can summon us through Alexa on Amazon. And you can also find all of these podcasts on Zacks.com as well. So until next time.